Hey folks, so I'm Rick Baldwin. I've been asked by Brett to sit in for for him while he's in Austin at that little conference they're having over there, and joined by Rick Hale. Have our little Monday chat. How is everybody today?
I'm great. So thanks for asking. So anybody that feels comfortable turning on their video, it's always more fun when we can see your face and kind of feel the energy of the conversation, and feel free to interact with us.
Okay, so listen, just a little background here. I work out of the Decatur office with Sean Damon as the team leader. And so for the last few years, I teach a class called Monthly Market Overview, MMO, Market Stats, that kind of thing. We look at similar data to what you guys talk about on every Monday afternoon. And we do this about once a month after we get the chart master data. And we combine looking at market statistics and trends and what's happening in the macro market, but we also drill down to the micro neighborhoods. And we also look at recent articles and things that are happening in the metropolitan area with construction, development, investment, businesses moving here, and those kinds of things, and the effect it has on residential value, right? So that's kind of the premise of what we do in our market center once a month, and what I do teaching that class, and you guys do the same thing here every Monday. So this is kind of a continuation of what we already talk about. I see some familiar faces who people have been in my class before. Hey, Amy, how are you? Yeah. So let's get going on it. You know, I've been on this call a few times, and so I'm going to share the screen because Brett likes to start off with looking at some data, right? Everybody likes data. Let's look at some data. Where's my? I'm going to share my screen.
Should be a green box.
Yeah. Where is that? Trying to share what he sent me earlier, and that is that last 7 days. Let me get that last 7 days. Here it is. Okay, so there you go. Can you see that?
Yes, sir. Good job.
Okay, so this is our familiar little chart, the Monday chart, looking at this activity, and this happens to be, I believe, DeKalb County. And the little tabs at the bottom, I can toggle back and forth to Fulton, DeKalb, Cobb, Gwinnett. I know there are folks from all around the metro area, but you know, the data isn't all that much different when I looked at the individual counties versus one another. When you look at the number of actives and under contracts as it goes week after week after week, right? You know, there's micro changes. Any insights here from anybody that is looking at this? Rick, were you feeling anything?
No, I mean, it's kind of the same story we've been seeing. There's a lot of consistency in the market, which, although, you know, can be frustrating if you're looking for a different narrative. The good news is if you found a strategy that's working, keep working it. It also says that, you know, homes are still selling fast. And if you own the listing, you own the outcome. So it's hard to, you know, navigate some of the multiple offer scenarios going on, but we've also seen some of that slip and slide based on the micro market you're serving.
Yeah. I mean, I know what I'm feeling, right? And I'm feeling, and FMLS in the matrix dashboard, there's a little widget that you can have on your dashboard, and it shows you the number of new listings that have come on in the metropolitan area over the last 24 hours, today, last 3 days, last 7 days. So I look at the last 24 hours in particular. I look at Wednesday, Thursday, Friday, right? And I've been looking at it for years. And you know, COVID was an aberration, but I can remember back when we moved from Q1 into Q2 and basically into the spring market, you started getting over 100 listings in a 24-hour period on a Wednesday, Thursday, Friday that would enter into the market, right? And so COVID put a little dent in that, but over the last couple of weeks, I've seen it go from 80 to 90 to 100 to 110 over that period of time. And to me, I felt like it was getting back to normal, right? Now I'm still battling the multiple offer situations and all that stuff. But the good underlying principle here is that there are new listings coming on the market, and that's encouraging. And it's especially encouraging because I have to be able to control this narrative to my clients, because they say, is this going to change? Is it going to get better? What's going on? Tell me, make me feel better about my opportunities here to find something to buy. And I have to revert back to, yes, I see more houses coming on the market every week, right? I do. And then we look at their criteria and, whether they're picky or not picky or whatever it is. But, I have this really good feeling right now that I'm seeing more houses on a seasonal basis than we did a year ago, right? I feel the seasonality is coming back. That's my gut feel. And the data is kind of reflecting that. Now, I don't see that here on this chart, but that's what I'm feeling, that there are new listings. There are transactions to be had out there. You got to fight for them, but they're there.
Yeah, the
Anybody have
argument.
any other feelings about that?
Well, the argument is there's just more buyers than there are listings, which makes it feel like we're in a supply side deficit. But the collective, the sheer number of homes sold year over year for the past number of years consecutive is that we're selling more homes.
Yep.
So it's really demand is greater than supply, in which, obviously changes the dynamic with working with buyers or sellers. But there's still opportunity. And we did sort of premise that in January and February that, hey, maybe there's some element that's post-COVID that really is a return to normal seasonality, where you tend to see a slowdown in listing count in January, February, March. And so the next month or two will be really telling.
Yeah. I think the last 2 weeks have been a leading indicator of hopefully what you just said, that we get into the height of the season, the lead up into, people wanting to sell, the end of school. I think the timing is coming around to back where it was in 2019, where you had people getting their listings ready to sell because their kids are graduating or school's out on Memorial Day, and they want to time it right to get into a new house by the time August rolls around. I'm feeling that. And that's a good thing, right? So, that's one part of the conversation for today. The other thing is that, we're all asked this question every single day by our clients, and that is, what's going on with inflation and interest rates? And are we in a bubble? And is there a recession looming? And all these kinds of wonky questions, which, sometimes I'm out of my league, right? So, but our clients look to us to have a perspective on it to help them understand what they may be reading in articles out there, right? They're coming to us asking for stuff. So I've got a couple articles that Brett had sent me this morning. Rick, you sent me one on about an hour or so ago about are we heading into a recession and those kinds of things. And I'll just say this before we get into that, is that, most of our clients are not are not C personalities. What I mean by that, they're not data wonks, right? And they're mostly S's or I's, okay, primarily I's. And this is DISC terminology that I still refer to, Rick. I just ingrained, but as much as we may like data and like the wonkiness of it and how it helps us do our job, I have to be really careful in communicating this to my clients, because most of them are not, right? Most of them are I's and S's, but all they want me to do is talk about, well, what do you think's going on here, right? And so, it's important to, when we read all these articles, can we put it down into everyday language that people can understand, right? Like, what's the difference between the recession bubble in 2007 and 8 and now? You better have an answer for that, right? Because there are some fundamental differences between then and now. And it really hinges around supply and demand, and not faulty mortgage lending practices and speculation, right? It has to do with just basically supply and demand, right? And so just by letting them know that that's what the data is showing us, and that's what experts are saying, gives them relief, and they feel relieved that, okay, this maybe not isn't, it maybe not a bubble, right? Because it's different, but they don't know that because they read articles. Anybody have any other thoughts about that kind of conversation that you're having? So Rick, can you give us a little synopsis of that article you sent us about the fundamentals around whether we're headed into a recession or not?
Yeah, and so there's different things that are key indicators that push towards bearish signals versus bullish. And bullish, obviously, I think most people get that's the optimistic side of where the economy is going and potential to earn and keep money and stability of the economic landscape. And so there's certain things that push and pull that, and a lot of this, at the end of the day, some of it's valid pain points that create stress in a person's economic outlook and future, but some of it's also a lot of this tends to almost funnel down into the consumer confidence bucket. And when people feel enabled and capable, they tend to take risks and make and invest in things that they're not 100% certain of, but feel confident they won't get sunk around. And so when there's that type of energy, people put their money down on positive opportunities, and it keeps that circulation of money. And again, consumer confidence is a big deal right now, and the consumer sentiment in general is not really at its highest point. So that's a bearish signal. I think gas prices and some of the there's just things are more expensive right now, staple goods and commodities. But on the positive side, employment gains are really, really strong. We're almost at historically low unemployment, and there's opportunity in the marketplace. Jobless claims are historically low. Household savings are above average. Built into that and baked into that data point, though, is also that most people have really good equity in their home. And Rick, you made a good point that supply and demand does drive ultimate pricing, and competition usually implies when there's high competition, someone will overpay. But the cool part is that people have equity. So there's not this, you said, what's the difference in the 08, 9, 10 experience in today? It's highly unlikely that we're going to fall prey to foreclosures and a rampant, momentum swing and inventory based on distress, because there's, if you've got equity in your home, you're probably not going to turn the keys over to the bank, and you're probably going to be a little more resistant to giving up on making, certain payments and staying, in good stead with your credit, because you still have enough confidence that, you may be able to not only pull out of it, but take cash as you go, or even roll it into a new opportunity if you're upsizing or downsizing. So household savings is above average right now. So statistically, it looks like there's more money available for people in terms of reserves. Corporate earnings are rising, but that's starting to decelerate a little bit. Talks a little bit about credit spreads, and I'm not going to go deep into that. But ultimately, we see gross domestic product slowing down, but not, it's more cautious than it is, red flag and concerning. I guess the biggest part of the entire story is that, their interest rates was a conversation to be had, and that creates some compression on affordability. Obviously, if you have to pay more to borrow money and lending tightens on some level, that means potentially fewer buyers. But we're so imbalanced right now. A little of that's probably a good thing, in my opinion. In the same way that if the Fed continues to raise rates, some of the, demand may go down on, for corporate purchasing and even consumer purchases, which by reducing some of that demand, it'll also pull down some of the pricing. And that's how the Fed attempts to control inflation. Yeah. So that's a big conversation all in about what, a 3-minute dissertation.
It is. Yeah. And our ability to distill that down into a brief conversation with our clients is really where the rubber hits the road for us, right? Yeah. To be able to say, well, what's going to change? Our price is gonna pop, really, and it's just the deceleration of affordability is going to have that, right? So correct. If rising rates tampen down demand just a little bit, then price appreciation, which has been 15%, in some neighborhoods higher a year for the last 2 or 3 years, it's going to have to decelerate to a certain degree. Not reduce or go back to where it was before, but it's going to have to it will go back down as certain people step away, right? But the thing is, people's lives just still go on. They still have kids, they still get new jobs, they still are relocating to Atlanta. So life goes on, and they're still in the market to buy or sell. And a raise in interest rates from where it is right now to 5 to 5.5 to 6 at the end of the year, the big picture, that's not that big of a deal compared to where interest rates were a few years ago. I think it's the big impact is going to be for the under $400,000 buyer, right? Those rates really affect those buyers quite a bit on their monthly payments. But if rates go up, and they're going to go up, the way they are, so demand is going to tampen down a little bit, but it's not going to change, in my opinion, much of what we're experiencing right now. And that is, we're going to have high competition for the rest of the year. There's just not enough sellers. Even if you double the month supply of inventory out there from 0.9 to 1.9, okay, so if you double that, that's still a serious seller's market, right? So we're still going to have the fundamental issues that we have right now working with buyers and sellers, and that is competition. That's not going to change. And I think that's what our clients need to know is, based upon all this stuff that's floating around there in articles, what do you think is going to happen? Well, it's going to continue to be competitive, and it's still going to, houses are still going to accelerate, be appreciating in price, and interest rates are going to go up. But now is a good time to buy. It's better than a year from now, because it's going to be higher interest rates and higher prices.
Yeah.
Because I get asked this all the time. Should I just wait? And I'm saying to them, well, why would you want to wait? If interest rates are going up and prices are going up, why would you wait?
Yeah, even if it's marginal and it's not 15%, show me 15% appreciation anywhere else with any consistency hedged against the stability of real estate.
Yeah. Maybe if they're patient, maybe there's less multiple offers out there. Like right now in certain zip codes around Decatur, that 70% of every transaction is a multiple offer situation. Now that's up from 50% in Q4. So 20%, more of these transactions are going into a multiple offer situation. So maybe there's a dampening down of that, but for the most part, it's probably going to stay the same. But you have to be able to be competitive, and if you're not, then maybe you should stay on the sidelines for a while if you can't be competitive in that regard.
Well, the most important thing you can do, Rick, is exactly what you're suggesting, is have sincere conversations around their motivation, their needs, their wants, and their life experience in that, in the, not only in the process, but in the landing pad. And does it align with their holistic family goals and their economic goals? And, are there more red flags or green lights, and you just have to help them cycle through it. What's the upside to waiting? What's the downside? What's the upside to now versus the downside? And the one thing, you at least know what today is. And if the dynamics lead to a positive experience and something they won't regret, you can show them on the trend line. And this is where you have to know your local economics and the appreciation for that immediate micro market. If you can show them that 3 to 5 years from now, no matter what the dynamic is for a year or two, it's probably going to net out a big win for them. Then, the key is to eliminate or mitigate some of that fear of the unknown. And the way to do that is expose it to light.
Yeah, it's a fear of the unknown. That's exactly right. That's where I like to tread pretty lightly here when they ask me these economic questions, especially some of my Wall Street clients, because it can get you can run down a rabbit hole with those guys, right? And so, but for most of the clients, it's basically they want you to just give them some assurances that we're looking at it, we have their best interest in mind, and we know where we need to, what we're trying to get them to, that end result that they need to get to, right? And that's just really the assurances that they need, right? And have a roadmap to get there, right? They need a map, they need a plan, they need a guide, and we're the guide, right? And there are some turbulent times out there, but we can figure it all out together. I'm going to share another screen right now, if that's okay. Okay.
Fire away.
I'm going to do a new share, and I'm going to do this, and I'm going to go there, and I'm going to look at that. Okay, so this is what I was referring to a few minutes ago. And so I did an analysis, I do it every quarter, of what has happened in the previous quarter versus what's happening now in terms of transactions at or above asking price. Okay, and so I looked at Q1 22 versus Q4 21. And here are the top takeaway bullets, which I have a chart coming up after this in just a second to support this. But basically, the percentage of the transactions that sold for at or over asking price increased to 70%, and the range was 67 to 75%. And that's based upon City of Decatur, Kirkwood, Eastlake, Edgewood, Tucker, and North Decatur, all the areas surrounding Decatur and the in-town neighborhoods. I just looked at that, right? And so that's up.
Can I ask you a question?
Yes, sir.
Of the percentage, Terry asked this question. It looks like you answered it in the very first bullet point. The way you're gauging the percentage that are over asking are the ones that sell for more than asking.
At or over, yes.
So that's where you know there are multiple offers. That's what I meant to say.
Yep.
It's uncommon that someone would pay over asking or full price, and maybe they rolled in a little bit of closing costs.
Yeah.
So it might be a percent or two lower, but typically that is the case.
Yes. And the second bullet is this. The median percent over asking, when they sold for over asking price, what was that median number, right? And the number is 7%. And in the fall, it was 4. Okay. So this is important because we need to manage the expectations of our clients and say, look, to get in the game, we're in a multiple offer situation. You have to be thinking at 5% over asking price or more, or we're not going to be in the game. And that's a big increase from Q4, right? And then the last bullet here is that for the ones that went over asking price, where was the top end? Where were some of these big winners, right? And in many cases, it went up to 20% over asking price, up from about 5 to 7% in the fall. Okay. So what I mean by this is the top end. If you really want to go super aggressive, the winners out there are going 20% over asking price. So in a nutshell, in summary, more transactions are going for at or over asking price, and the median percent over is higher, and the top end is high, much higher than it was in the fall. So basically, it's a super hyper competitive, exuberant market. That's the Fed uses that word pretty liberally these days. It's an exuberant market right now. It is. And you know, that our ability to manage that is really where you know, our effectiveness with our client is going to be, you know, good. And here's the chart that basically that I get all that from. And you can see that these are the different, on the left-hand column are the different market areas: City of Decatur, 3033, 8417. And then the Decatur office of Pharma. And so you can see in this particular column here in the middle where it says Q1 2022, you can see the red numbers as you go down. That's the number of the percentage of those transactions that were at or over asking price in those market areas. And if you look to the column to the left, you can see in red that percentage, that's the median percentage over. So in City of Decatur, the median percentage over was 4%. In 3033 was 7. In Tucker, it was 4%. In Kirkwood and Eastlake and Edgewood, it was 9%. And then for Quirma, that means our market center in Decatur, it was 8% for our listings and 4% for our sales, right? Those are higher numbers than it was in the fall, right? And so anyway, that is a you know, kind of a
helpful chart.
A chart and information that I felt was that my clients, especially my buyer clients, really found that effective because it tells them where their head needs to be at, right? You know, so for instance, if they say, you know, I can afford up to 450, well, my conversation has to be, well, we need to look up to 400 because you're going to spend 450, right? We can't look at 450. You can't. By the time we get into a multiple offer, we're not going to be able to be competitive.
Right. Well, and then the question is that because you've chosen that line in the sand, or is that truly your affordability maximum? And if it's a choice, not, you know, Like who's driving that experience? And then, I think a professional consultant will then allow them, even if it's at 450 to 475, or if they can afford it, make sure you have that conversation around what does that look like in terms of lifestyle and experience. And are you eliminating certain areas that would create a better experience and more upside security? Because here is another thing that I would recommend you have conversationally. When the market did shift in 2008 and 9, the people that got stung the hardest were the ones that were betting on up and coming markets that were outside the concentric circles of already proven territories or areas. So in other words, there are people, here's a quick example, Grant Park downtown, all of a sudden Summer Hill and west of that even became considered Grant Park, when it really, it kind of was, because it was bleeding over, if you will, in terms of popularity and price appreciation, because, affordability in Grant Park proper became difficult. But what happened when the market shifted, those neighborhoods gave back those gains and appreciation fastest, because the heart of the real, the source for, consumer confidence, and it held better there. So you just want the conversation. So if you spend a little more, do you buy a little more security if appreciation is important, and if there's a potential that you'd have to sell inside of 2 to 3 or 4 years? Does that make sense?
Yep.
So, but it's about, does whether you can or want to or have to, and just, where does that flags, where's the line in the sand?
Yeah. There's a question about how do I know whether these ones that sold for over asking price were multiple offers? Well, I don't know specifically that, but just from experience, if they sold for over asking price, it's probably there was a competitive situation. It may not be 10 or 15 offers. It may be 1 or 2 that we're competing with. But if it went over asking price, the chances are there was some kind of competition.
Valid point.
I'm going to, before I leave here, I think I'm going to try to put some of those articles. So somebody asked Rick if we could, can you put that article that you just were talking about into the chat?
I think so. Let me see if I can. It's an email. That's the only.
It was an email. Yeah.
I got it from one of my investment brokers. He sent it today, and I found it appealing. Obviously, it was a cool article. See if there's a way. If I scanned it and put it in there, I could. Here's the thing. If someone wants that article, I'll just forward that to them.
That's better.
Rick at rickhale.com.
So if you want that exact article that shows there's a cool graphic that shows here. I'll just post it real quick while maybe I can. Let me see if I can find it again. So here we go. Can you see that?
Yeah.
So it just shows what are things that signal bearish versus bullish. And I kind of quickly summarized it. Remember my 3-minute kind of dissert, but then it goes into some detail about the bottom line and what those indicators mean and how they impact perception and reality. So yeah, if Rick at rickhale.com, I'll forward this exact email to you. And then whatever else we got a couple minutes, barely. We're running out of time. Yeah. This has been good. Anybody have a specific question on today's conversation?
So this question may be for another day because we're almost out of time. But I'm wondering how to best counsel clients who are, planning a move. They could move this year or next year, and they're wondering if they should sell now or wait. And of course, we have tools, so that they can remain in their home 60 days after close. They can do financing that allows them to buy before they sell. And I would just love another day for us to have a conversation about how we counsel our sellers. Naturally, I'm wanting to find encouragement because I need more listings so, for moving now. So surprise. So for doing it now rather than later. And of course, we always say, it depends on their particular circumstance, but a lot of times they have a little wiggle room. So That's all.
Yeah, I mean, I would just quickly say the number one deterrent from people selling a home now and migrating somewhere local, like to something better, is the fear of not finding better. And the only way for you to bring that value is to show them that path and potential. And then the second half of that conversation is, if you are an intelligent consumer or investor, the ideal thing to do is sell high and buy low. Right now, the good news is you're buying in the same dynamic market unless you travel really exurb or suburb or somewhere unique. Like if you're in Decatur and you're going to Grant Park or Midtown or Morningside or, even Alpharetta and Roswell, the dynamics may be similar enough that you're just trading even for the upside of which market's stronger or weaker. But having that conversation around what does quality of life look like? What's the experience look like? And if that's not bigger than the risk and fear of making a mistake, they're probably going to just, anchor down. That's been my experience. And so you've got to kind of show them the path to safe island, if you will. If you were trying to swim across with sharks, here's a boat, here's a motor, I'm going to take you across and show them the way. And then the last half of that, show me the way. And if things go horribly wrong, we get your house sold in a day, say, even if you have 6 weeks to live there and move out, like some extreme scenario, what's your backup plan? And as long as there's a backup plan, I don't think many would argue that we're at some version of either a flattening or peaking or, to the point earlier, we've had 10 years of double digit appreciation. It wouldn't be uncommon to slow down a little bit. Does that make sense? And then, but you just have to have either a rental scenario or a short-term gap, or, there just needs to be an answer, or, there's some creative financing strategies to buy a home before you list and sell. And so that opens up another opportunity, but it's all in conversation and highly personal and isolated to each conversation.
Thanks so much. Appreciate that.
Yeah. People are more, fear is a greater influence than opportunity. So you have to identify where their pain points and their fear lives, and then help them get comfortable with that not being as daunting as it probably feels, because I get it. I sold my house last summer, wanted to move. I kind of made a quick panic buy just to have a place to live. And then I figured I'd either expand or change later, but I went from a big house to a, half the price townhome. Not because I really wanted a townhome, but I didn't want to rent, and I knew it would serve my needs until I really figured out plan C and D. Does that make sense? But that was because I did a lot of personal consulting and confirmed with my wife that she was okay with it. And Rick made an incredible point earlier about personality profiles and making sure you honor, their level of, knowledge and experience, as well as just general risk aversion versus embracement. And make sure that you listen closely to each party and make sure they all have a voice in it, because one dissenter in a couple usually spoils the opportunity.
That makes a lot of sense.
I think
That's true. Somebody doesn't want to, they'll find a way to kill the deal.
Yeah, that's right.
No doubt about it.
And if you put in front of them, the different options and the different roadmap options, we could go down this road or this road or this road, right? And you're the guide, but you lay it out in front of them so that there's not this fear of, well, what happens if we do this, or what happens if we do that? Well, just lay out the roadmap. If you do this, this is the path that we're going to take. If we do this, this is the likely path, and then there's this other likely path. And it all depends on your ability to stomach the risk on each path, right? And they'll make a decision, but at least now they see, okay, we have a way out of this. We have a pathway. And you're going to help us get there, right, Rick? Yep.
There you go.
We're going to figure it out, right? But we're going to be patient, and we're going to do our due diligence, and we're going to make informed decisions. And we're not going to rush into everything. But we're having this conversation so you know what all your options are, and we can manage those expectations as we get into that, right? And they appreciate that, and that's just spending time with them, and it's. For some people, it's an eye opener that they never realized that we could do it this way, or we could do it that way, or whatever it may be.
Awesome points.
Thank you so much.
All right.
So I think we're done.
Yeah, we're out of time, but it's been great, Rick. I appreciate you, my friend. You're an amazing thought leader and such a contributor every day. And man, just you make our world better. So thanks for all that are on the call and listen later as well.
Bye, folks. See you later.
Bye-bye.
Bye-bye.